Welcome to this explainer. Okay, we're diving straight into a really fascinating shift in cryptocurrency strategy today. We're moving away from traditional fiat-based metrics and exploring how algorithms can systematically build your portfolio. We're looking at some seriously compelling source material that breaks down a sophisticated yet surprisingly accessible way to grow your crypto assets. It completely challenges the standard approaches most of us are used to, you know? It introduces a totally different philosophy of what it actually means to build wealth in the crypto space.
So I want you to ask yourself a crucial question. Are you collecting dollars or are you collecting crypto coins? Because for true long-term believers, the real hodlers out there, the ultimate goal isn't necessarily fiat profit. It's not just about seeing your portfolio value in US dollars briefly spike. The real goal, it's accumulating more units of the assets you genuinely believe in. Think about it. Do you want to end the year with the same one Bitcoin that just happens to be worth more dollars? Or do you want to end the year holding 1.2 Bitcoin? That massive shift in mindset is exactly what we are unpacking right now.
Here's what we'll be covering in this explainer. 1. The goals of a long-term investor. 2. Pair trading versus staking. 3. Selecting the best crypto pair. And 4. The exact steps to automate this accumulation. Let's get right to it.
Section 1. Goals of a long-term investor. Redefining portfolio success. If we want to really grasp algorithmic accumulation, we first have to totally redefine what portfolio success actually looks like. While normal trading measures success in dollars or stablecoins, the pair trading philosophy focuses entirely on using market volatility to systematically increase your actual coin count, like your total number of Bitcoin or Ethereum. Think of it this way. Traditional trading is constantly swapping crypto back into fiat just to lock in a profit. But the pair trading model we're exploring today, it's a relative value strategy. It literally uses a secondary crypto asset as fuel to capture natural price swings in the market. The sole objective is growing your stack of a primary asset. Your ultimate metric of success is simply this: do I have more coins today than I did yesterday?
Moving on to Section 2. Pair trading versus staking. Understanding the real risks. What's really interesting here is how we achieve that accumulation, because these two main vehicles have vastly different risk profiles. The absolute most fundamental difference is custody. Staking requires you to hand over control to a protocol. And let's be real, protocols can be hacked, subjected to bugs, or face nasty slashing penalties. You're essentially lending your coins out and just hoping a third party keeps them safe. On the flip side, spot pair trading keeps your assets directly in your own exchange account. You and your assets are inseparable. There's zero counterparty risk here, and absolutely no smart contracts to get exploited. You are working directly with the real assets on the spot market. There is a super clear trade-off to consider here. Staking gives a theoretically fixed yield, sure, but it introduces massive liquidity lockups and counterparty risks. Your funds are often locked up for ages, and the rewards you get are sometimes just created out of thin air. That causes inflation that suppresses the coin's actual price. But pair trading, it gives you full liquidity. You can stop it at any second. And it generates returns not from inflation, but from natural asset price volatility. The main catch, though, is market unpredictability. If the two assets you're trading suddenly lose their historical correlation, well, the strategy can falter.
Section 3. Selecting the best crypto pair. The criteria for success.
You really can't just pick any two random coins for this to work. Everything hinges on this core concept of mean reversion. It's the absolute engine of the whole strategy. Let's look at an example straight from the source material: Ethereum and WorldCoin. Now, they aren't competitors, right? But they often share institutional interest and react super similarly to macro news. The algorithm tracks the price ratio between them. When a pair like Ethereum and WorldCoin temporarily drift apart in value, say WorldCoin suddenly becomes ridiculously cheap relative to Ethereum, the algorithm expects them to eventually snap back to their historical norm. It automatically sells the temporarily overvalued asset and buys the undervalued one, just waiting for that snapback. But to ensure the algorithm has the absolute best chance of succeeding, the assets must meet some strict criteria. Otherwise, the strategy could result in permanent losses if the coins just drift apart forever. First off, you need deep market liquidity, so your trades actually execute without massive slippage. You also need that strong historical price correlation and, ideally, a fundamental connection so it makes logical sense why they move together.
And of course, you absolutely need volatility. If the prices just stay completely flat, the ratio never changes, and the algorithm literally has no opportunities to rotate the assets and accumulate coins. Tools analyze all this historical data to set percentile ceilings and floors, typically an 80-20 split, so the 80th and 20th percentiles. When the ratio hits these extreme boundaries, the system automatically sells the overvalued asset and buys the undervalued one. Imagine a channel. If the price ratio hits the ceiling, the 80th percentile, it's a statistical signal that asset A is overbought compared to asset B. The tool just executes the trade without any emotion. When it drops to the floor, the 20th percentile, it rotates right back. It's just pure, emotionless math.
Bringing us to Section 4, Steps to Automate Accumulation, Executing the Strategy. Now that we've got the theory and the risks down, let's talk execution. There are 4 critical steps to getting started with automation tools designed for this, like PairStacker. Open an account on a supported exchange, create API keys with trade-only permissions, deposit your initial capital, and finally configure your percentiles to launch the algorithm. I literally cannot stress enough how important step 2 is here. Never ever give an automated tool withdrawal permissions. The beauty of this setup is that you use API keys that only allow the software to read data and execute trades. Your coins never leave your exchange wallet. The tool acts like a blind assistant. It can reorganize your desk, but it physically can't take anything out of the room. This completely wipes out the counterparty risks we talked about with staking.
During that final setup phase, you're the manager. You have to meticulously define these parameters based on historical backtesting to balance risk and transaction fees. You got to choose your target asset, like what coin do you actually want more of. Then you select the pair asset, set the historical analysis period, define those entry percentile boundaries, and set specific order sizes. It takes thought. If you set the boundaries too tight, you're going to trade constantly and just get eaten alive by exchange fees. But if you set them too wide, you might wait months for a single trade. It's a really delicate balance that requires solid historical analysis. Please remember though, even with all this heavy automation, market conditions can shift drastically. Automation is not a set it and forget it passive income tool. It requires active monitoring and strict risk management to ensure the historical price correlation, often called co-integration, hasn't permanently broken. The sources are incredibly clear on this point. This is not a magic wand for guaranteed passive income. If the fundamental relationship between your 2 chosen coins breaks down, like say if one project suffers a fatal hack, the algorithm will just keep buying the dying coin because it wrongly thinks it's undervalued. You have to be an active manager of this automated process. Taking control of your assets on the spot market definitely requires technical discipline, but the ultimate question remains: are you ready to automate your portfolio? Are you ready to take the leap from passively holding dollars to actively stacking coins? We've seen how shifting our goal from fiat profit to coin accumulation totally changes the game. We've seen exactly how spot pair trading keeps you in control compared to the hidden, sometimes scary risks of staking. Yeah, it takes effort, backtesting, and a cool head, but algorithmically stacking the assets you genuinely believe in, that is a phenomenally powerful tool for the long-term investor. So as we wrap up this explainer, I'll leave you with this. Are you going to keep chasing fiat, or are you ready to systematically build your stack?